TGIF warriors. And let's not go out with a whimper. Let's go out with a bang. NFP today. Everyone doing this was the week of falling wedges for me. So I saw them last Saturday. We got the touch in the euro. Very close to a turnaround Tuesday call made around, I don't know, 96.85, 96.90, around there. Dollars had a reversal week, but here, this was the first falling wedge. Euro coming out of it, even though the pound was a star. And this was a real performing falling wedge. Same type of thing, breakout in the S&Ps. Who would have thought after Apple's report, earnings report, and that they're not going to list units of phones anymore, so they're not going to be as transparent because they don't want to be seen as a hardware company, and it was down 11 bucks, that you'd come into the S&Ps up 30 and NASDAQ up 71 with what Apple did yesterday afternoon. So it's my contention, as long as we have a weak dollar, which was a problem, that the market's probably okay too. So we did close back underneath the throwover that I pointed out. So it should have trouble up around 640, 650 if it tries to rally on a strong number. First target being around 95.5. But the most unexpected thing would be, before it's over, here's 95.5 too, that we clean out the dollar bulls under here, and over the next few weeks, maybe, into the end of the year, the dollar heads back down to 93 before it tries to resume the uptrend. But first stop is here, 95.5. See this green line? It's been a very important pivot. So, if you're short from the turnaround Tuesday call or anything I've said, you got to take something off before the NFP. All right, not a bad level. And then let's see what kind of reaction we get from 95.60 or so. So the other question I posed was, gold was rallying without the dollar. The dollar was strong while the precious metals were rallying. And the question I posed to myself and spoke out loud in here was, if gold could act good with a strong dollar, I'm curious how it'll act if the dollar loses its bid. Well, we got our answer yesterday. Took a lot of pressure off the gold. Huge up day yesterday. Looks like new highs are coming. I wouldn't chase this either, but perhaps this opens the door for, 1265 or so. While the dollar, if the dollar is going to that 93, 92.5 level, why couldn't gold rally another $30? It did 20 in a day yesterday. And then silver took over leadership yesterday. In fact, I'm going to have Steve pull up his gold-silver ratio chart. I think there was a huge day yesterday that may be indicative of a top. I saw it on Twitter. A guy who tweets in my feed put up a real nice chart of that. In fact, I invited Chint to be with us in January. His stuff is so good. So, there's a guy with, 300-400 followers that is an excellent tactician, and probably better with people that have, 21,000 like me. So on Fridays, I like to remind everyone it's a great day to become part of the ForexAnalytix trading community and take the trial and navigate around, get a feel for all the analysts. I think we have, and then you get to hear the voice, and you get your traffic light page. You get to hear, who is that mystery woman? Who is that? So, and also, I'd like to invite everyone to go and talk to Trent and Justin at Forest Park FX. Find the right broker for you. Okay, reimbursement program if you're overseas, rebate program if you're in the US. So they know every broker out there, and they're going to find you. You probably have a better chance of getting tighter spread deals with going through these guys than you would on your own. It's just, coming in there off the internet. So looking forward to the number. My vibe is to fade dollar strength if we get a strong move, hi Kareem, we get a strong report and the dollar tries to rally, I would think about fading that. So let's see what happens on the NFP. I'm not a big fan of holding big positions into it. So maybe we get some type of pullback in the euro on this NFP shorter term. Looks like, back near the wedge line, that's going to come in around 1390 or so, 1380. And that's going to be important. This low is going to be important for the bull case to keep going towards 15 or so. You look at this and, I know there's a lot of overhead resistance all the way up here, but I think the big surprise would be if we had something like this from here, and that would take the Dixie up towards 118, the euro up towards 118 or so. Again, clean out the euro bears that are looking for parity first. But it could just be another failing rally. Here's some resistance levels right here, 1560, and then you have the channel line at 116 or so. So I really think that's the next challenge, this moving average, 15.5 to 16. So I'm looking to buy pullbacks if we get a good number, and the area on the euro that looks attractive would be where I have a lot of confluence. This is where the wedge broke out, 1380-ish, 1390 in here. So 50 pip break could be a decent buying opportunity, give you a chance to get long on the breakout one more time. So it checked it once, maybe one more time. And want to thank everyone for their loyalty of being supporting our work. We give it our all every week. Our mission is to build you up, to edify you, give you a better chance of success than you'd have on your own. And with 90% of the other companies, education, whatever kind of company they are. And it's not just one of us where we stand up and you stand up too. It's a whole team. So, 1 + 1 = 11 or 111 in this case. So everyone have a great weekend. I do have a nice interview with Peter Goldstein lined up. Peter was here and had technical difficulties. I think his site is 61.8, so he's a fib guy. He's using harmonics, and I've seen him be real right about NASDAQ and some other things in the past, and looking forward to seeing what he sees with market structure at the top of the hour. So with that being said, hi Blake, how are you? How's it going, buddy?
Good. How you doing?
TGIF, buddy.
TGIF, it is. Yeah. It's going well. It's been a great couple of days. I just as I got up this morning, about an hour and a half, 2 hours ago, I took some positions off. I took the euro off. I'll show you guys what I'm doing here. I am short dollar Canadian, and I've got my stops already at break even. So I'm taking that into the jobs report, because now it's a stress-free trade. It's, because I booked profits elsewhere. Right. But yeah, I had a euro dollar, took that off around here, not too far from where we're currently at. We just hit a downtrend line. This is the downtrend line. You can see it on the hourly. We just hit it. I mean, if you use ForexAnalytix, here is the basic technical analysis. You guys got that an hour ago. when we were sitting up at 53. We've already dropped 10 pips since then. So, you know, we know that's key. And the fact of the matter is if we break the highs, we're going to continue to squeeze, which I think is going to be the case. I just don't, I don't necessarily want to be long or short a bunch of dollars going into NFP, because, you know, what if the numbers are really strong and, you know, the dollar, you know, does a reversal, you know. So, you know, I pared back some of my dollar shorts, but I mean, it's been a great ride. You know, I scalped the cable on the long side a bunch yesterday. We stopped at the 618. So notice this is pretty key here with the pound. Go back to yesterday. Okay, we go back to yesterday and we didn't quite hit the 618 retracement at 130.43. Okay, we didn't quite hit it. So it's like the cable had unfinished business up there, and we went and hit it overnight. Relative strength was divergent, and now we're pulling back. Will we break the 130.50 following the numbers? You know, it's a high possibility, I think, but we have to work off some of this overbought conditions. So, you know, over the next 15-20 minutes, I would expect the pound probably pulls back below 130 and maybe back to 129.90. You know, fine. You know, when you get overbought, this type of action here, and let me pull up a pen, a good color pen. When you have overbought intraday indicators like this hourly, we have to consolidate, like you're seeing, okay, to work off the overboughtness, and then the RSI becomes reset as price consolidates. Then we can be free to move up again, and RSI start moving up again. So you have to work off some of these overbought conditions, as we talked about, Dale, is in time, and let them, you know, work off and consolidate, and then you know, relative strength can normalize. And so that's what we're seeing with the cable. And like I said, I would not be surprised to see the cable, you know, slip back here into the, you know, 90s, and here we are. The Euro's already, you know, pulling back a little bit from this trendline resistance. The Aussie, this is big. If and I don't know if you guys have caught this. Again, if you use ForexAnalytix, you got this analysis. We hit the 161% extension in the channel resistance. We hit the channel resistance, and, you know, the Aussie's already, you know, slipped off of those highs. Now, does that mean the Aussie can't go any higher? No, but I'll tell you what, we have to work off some of these overbought signals, and if we break 72.60, we're probably going to see 74 cents again, which I think is the, you know, higher probability at this point. I think that's actually what's going to happen. One of the I guess that
would tie in with new highs for gold.
Yeah, and gold just slipped pretty good. Gold just fell $3 just a moment ago.
Up
just
20,
over the last,
down 3, no big deal.
Yeah, but the Kiwi, man, this is a breakout. This is a major breakout. Now I have some New Zealand yen longs going, but and you can see why. This New Zealand yen's got a quadruple bottom, but we hit resistance. Everybody should have known we hit resistance. I, you know, just sent out the analysis this morning when we were at 75.45. So we're up against resistance, but how big is this if this breaks? If that breaks, I mean, this is a quadruple bottom, which doesn't happen often. You know, you see double bottoms, triple bottoms a lot. Quadruple bottoms, not so much. But that's where that points, right? So you can do that. It looks something like that. If that breaks out, and I think that looks extremely bullish, the New Zealand yen. But, you know, we obviously have to break through highs. Now, what do you think, Coach? Looking at the New Zealand yen, And if you guys have ForexAnalytix, you already know this because it's spoiler alert. It's in the analysis. But what do you think takes the New Zealand yen higher, Coach? What do you think? And you haven't had a chance to read the analysis. That's why I'm kind of, or maybe you have. I don't know. What do you think to make the New Zealand yen go higher?
Some type of compromise with China.
Well, that would do it. But if you guys haven't seen it, the S&P is at the 200-day moving average. So I think if the S&P breaks the 200-day moving average, the New Zealand yen is going higher. All right.
Look at the weekly on the S&P. What a recovery!
It is. You know, now I read some analysis from Jim Rogers 2 days ago, and I thought it was really good. Jim Rogers is a legend. He is, you know, the commodities guru. I actually met him in person. We had him speak at one of our conferences with the Wise Trade Group 12 years ago, maybe 10 years ago. And so I got to meet him in person. He was living in Asia, and I think his wife's Asian, but his son was being brought up in Asia because he said China is going to be the next, you know, it's going to be the next big, you know, powerhouse, global powerhouse, which,
Singapore.
Was he in Singapore?
Yeah.
Yeah, he was in Singapore, but he was making sure his son learned Chinese and blah, blah, blah. And this was 10, 12 years ago, which he's been correct. And he's an amazing person, very, very cocky, very full of himself, too. But you can't deny his greatness either. You know, he's really, truly that's when his book Hot Commodities came out. And anyway, I was reading his analysis, and I don't follow him per se, but you know, if a piece of his analysis comes across my desk, I'll read it. And he said, and I'm not quoting, but I'm going to give you the roundabout idea. The U.S., and this, I 100% agree with this analysis, the U.S. and China are going to patch. I use the term patch it up, but they're gonna basically, you know, kind of, you know, come to terms on this trade war. And what's everybody going to do? Everybody's going to say, you know, oh, this is it. China and the U.S., everything's all good. They're gonna take these markets. He thinks they're gonna take them to highs. I don't think they're gonna take them to highs. I personally don't. But he thinks that everybody's gonna think it's safe to get back in the water. The market's gonna go back up again. Now he thinks the market's gonna hit new highs. But just as the market hits new highs, that's when we reverse aggressively, and we sell off to new lows, and we have what he calls a crash. Now he uses the term crash. I'm not going to use the term crash because I don't necessarily believe that's the case. But I think we're going to, you know, race higher and then not make new highs, and then eventually, you know, go down and continue to go down. And his reasoning, which I 100% agree with, is that he believes that you know, the tariffs, the current tariffs that we have, is going to take hold, and it's going to start to bite the real economy. And our cyclical slowdown, we're meeting not only these tariffs and everything else, and this trade war, if you will, it's all coming to a head with slower economic data as we hit a cyclical top from an economy macro standpoint and turn lower. So I do believe he's correct that we are going to go down after that. I personally think that we're in a cyclical. We're going to have a cyclical downturn regardless of what happens with the trade war here over the next year or two. So it's going to be a rough couple of years. I think you know, as we've had one of the longest expansions in history. We're probably going to see fairly long recessionary type of period. Whether it's you know, 6 months or whether it's 2 years is to be seen. I think we'll probably be closer to the latter, but that's when it's going to bite, and I think stocks are going to come down after that, which he thinks that stocks are going to crash. I don't like trying to forecast crashes. But I do think that the stock market's got a lot of correcting to do. But the fact of the matter is I think that China-U.S. tensions are going to ease, you know, after the G20 summit in November, and everybody's going to think it's safe to get back in the water, and the stock market's going to go higher. I don't know if it's going to hit new highs, but I think we're going higher from where we're currently at. That doesn't necessarily mean anything for today. I just wanted to give you my thoughts on that. Now, as far as today goes, let's talk about here's the Kiwi. So the Kiwi's in breakout territory. Obviously, we're coming up to some pretty big resistance zone for the Kiwi. We're already tagging the lower end of the resistance zone. 161% extension is coming up. I was long the Kiwi overnight. Already pulled that off. Which hold on one second. Hold on one second. One second. One second. Okay. I already, you know, pulled my Kiwi off here, but I do want to buy it on dips. I do think buying dips in the New Zealand dollar is the way to go now. We came out of this channel, and I think we're going to eventually break this, you know, 67 cents. I'd like to buy it closer to 66 cents if I can get it. Now, the dollar Canadian, I do have a short in it, but you know, I'm shorting it with stops above. Well, I mean, my stops are at break even at 131, but as long as we stay below 131.57, I remain bearish. I just don't want to risk a whole lot today, so that's why I moved my stops to break even. But you know, Canada is reporting their jobs report today, which we had a huge beat last month. Don't forget. I think we printed 63,000 jobs. A lot of them were part-time work or employment, excuse me.
Yeah, the qualitative data were bad actually. You're right about that, I remember.
Yeah, and
Good morning.
Good morning. It was a strong piece of data. We are expecting a little bit less today, but the guys over at Gellos Capital made a good point yesterday, which I agree with. They're the only central bank right now that's hiking rates alongside the Fed. So I think that the risk is the dollar Canadian can move lower, and also that they decided that Canada is going to receive a lot more in investment moving forward with the, you know, U.S. Canadian new USMCA deal in play. Technically, I just care if the dollar Canadian hits new lows, because if it hits new lows from current levels, that means we broke this this trend line here. So if we break 130.50, then it does expose a move back below 130. That's my, you know, my 2 cents. I do have a small short, and I'll be adding if it breaks down. The peso, I have to say that was I'm going to have to pat myself on the back. It was a really good short that I took 2 days ago when it was at 240. Unfortunately, I'm going to kick myself in the rear end because I pulled it off too early when we were down here at 20.15. We are testing 1990 right now, but you know, I'll just reiterate, we've seen this whole pattern before. Same bat pattern, same bat channel. Same bat time, same bat channel. Is that, who used to say that, Dale? You would know that. Same bat time, same bat channel.
That was on the original Batman series, right?
Yeah, I thought so. I thought so. But who said that? Who would say that? I used to watch Batman as a kid, but I can't remember.
His butler.
Was his butler? Is that was it?
Yeah.
Okay. Well, I knew somebody would know it, and you know, the Tyrannosaurus Rex in the group should know it. Sorry,
you're talking about Stelios.
Talking about Stelios. So he definitely has probably a better memory than I do at that point in time. But Stelios, you used to watch that as a kid, right?
Of course.
Yeah.
Of course.
Who didn't? Anyway.
The original Star Trek as well. All that. Yeah.
Yes. Sir. I was a Battlestar Galactica guy. Sorry. Anyway,
you're more like the Riddler, man.
but we saw the same pattern here play out, and so the U.S. dollar Mexican peso should find some support around 1970. That was a big breakout point. It's hard to stay short the U.S. dollar Mexican peso anyway, with the caravans and the troops going to the border. It's a little scary. That's one of the reasons why I pulled it off personally. You know, an epic failure here was the dollar Swiss. This is a big epic failure. Above 101, above 1.0070. I don't know what to do with it now, but for those, there was a lot of traders in our chat room that were short the dollar Swiss that caught that. Congratulations. I don't know what to do with it here. I've been kind of perplexed with the dollar Swiss in recent weeks anyway. Even though it was very clear from a chart pattern standpoint, it just didn't make sense for me. More on a fundamental standpoint to be buying the dollar Swiss. I didn't get it. So anyway,
everything you talked about this morning, Blake, kind of portends a much weaker dollar. If the commodity currencies break out above levels after this big move, almost everything, if there's gets through resistance, we're going to have a big move down in the dollar.
Yeah, so I do, and you know what so the dollar yen is going to be the one that is not going to trade like the rest of the dollars, obviously, because of risk appetite and risk aversion. So if the S&P breaks the 200-day moving average, which I think is going to happen, I actually think that, you know, as I told you, I think the S&P is going higher. But if we break out, the dollar yen shouldn't break back below like 112. I mean, we should hold 112. We did stall at the 618 retracement, but also don't forget here, we had a false breakdown here in the dollar yen. So even if it's a weak number, so like let's say the number is weak, you know, and the dollar goes down, so the euro goes up, the Kiwi goes up, blah blah blah. The stock market may actually applaud a weaker number, because they would say, oh, the Fed's not going to continue to tighten, you know, market's going to rally. And the dollar yen may blip down and then push higher. So, and if the S&P breaks highs today, like, so you look at today's highs, whatever the highs are overnight, the highs overnight are 27.66. So we're 7-8 points away from there. If we break those highs, I think the dollar yen goes higher, regardless if it trades down to 112.25 or it just trades up. So, you know, watch. Not only it's the dollar yen, but it's the euro yen, pound yen. Euro yen broke the down channel. You know, you got the Aussie yen, which is at channel resistance. You got the Kiwi yen that broke channel resistance. It's got a quadruple bottom. You know, the Canadian yen. You know, this thing could rip higher, especially if, you know, if the Canadian data is strong, U.S. data is weak, the Canadian yen could be trading back at 88 pretty easily. So there's a lot. These yen pairs actually look really, you know, I think pretty bullish. Anyway, with that being said, I've got 2 minutes to get going. So you guys, TGIF, have a great Friday and good luck today. And thanks, guys.
See you, Blake.
Thank you, Blake. See you later, mate.
Hi, Steve.
Hey, Dale. Hey, Stel.
Hello. We have a lot of stuff coming up now.
Oh, so yeah, we do have a lot of stuff. So, you know, we have less than a minute left for NFPs, unemployment, participation rate.
Average hourly earnings, very important.
Canadian data of employment as well. So, you know, I'm going to keep the USD CAD here at the bottom middle. We have the USD yen at the bottom right.
The dogs are ready, man. Who let the dogs out?
The dogs are ready. Yeah, I hear Millie being ready to attack the numbers.
The dogs of NFP.
Yeah, indeed. So
that was a bearish bark. So let's
see what we get.
Are they laying on their stomach or back? That'll tell you.
Let's see what we get. A few seconds.
Right.
Steve, guess the number.
Nah, I don't like that.
Come on.
There's no point. If you're asking me stronger or weaker,
all right, I'll ask you
won't
that.
make a difference.
Okay. 250. Wow, that's
stronger.
big.
Yeah.
See, good guess.
Revision slightly lower, so that's a strong number. Average hourly earnings in line.
3.7% unemployment as expected.
But participation rate rose 0.2%, so that's not bad actually. So overall, good numbers, I think.
So unemployment at 3.7 with participation rate increasing. Okay, yeah. So
Yes.
that's actually
So the dollar is bouncing.
Very good employment numbers. What about the Canadian data, Celia? What did we get from there?
Marginally weaker. 11K versus 12K very expected. So
averagely hourly earnings as expected, which is 3.1 versus 3.1. What did you say about Canadian data? You said marginally better.
No, marginally worse, but like 1,000 jobs, so nothing.
Okay. So yeah, nothing to write home about. So the move we're seeing here in the USD CAD is purely due to USD catching a bid here, and it's a good place to catch a bid because as Blake was mentioning, several dollar pairs, the cable, we were talking about it yesterday night in the chat room, the euro, for example, USD yen. Blake showed some more pairs, they were at resistance, so we might see, and most importantly, if we switch to the DXY, you can see that the DXY was also, actually, let me go down to the 4-hour chart in the DXY. So if we go to the 4-hour chart in the DXY, here it is. You can see that the DXY, I actually even posted about it as an update earlier on. It was hitting a confluence of supports here, and we're seeing a rebound. This is the DXY from the 96 area and these previous resistance levels. Now it acted as support. So let's see what kind of a follow through we're going to get in the market having to do with that. Definitely the numbers are good. There's no question about it. But let's see if the market is going to find this as an opportunity to sell more dollars, because the reversals that we got yesterday are undoubtedly big. And we had already started talking about it in yesterday's webinar. All the reversals that we were looking for actually got confirmed. Some of them actually extended even further. A good example of that was the cable. Cable had like a monstrous bullish day yesterday. Obviously, in big part, this is due to the market being caught completely wrong-footed in this. But no surprise, it stalled where it did, because this is the 130 resistance area and the 50 daily moving average. As you see, this area has been support resistance multiple times in the past. Given the fact that we had a monstrous day, there is a decent chance for a scalp lower. That's what I was telling people, because we had some people in the chat room yesterday that were actually shorting cable at the highs. What I told them, to be exact, and my position remains the exact same one, is that I do see the potential for a pullback from here, but personally I wouldn't be ignoring the candlestick we got yesterday. So I think that even if we see some type of a pullback towards 129, I think that we're going to find buyers willing to step in. And speaking of which, you already see that the market isn't yet producing much of a follow through to the USD bullish move, and given the fact that data were on all aspects bullish, on all aspects. I mean, average hourly earnings were as expected, which was high. 3.1 is a high number. A participation rate rose, which is something that rarely happens. The nominal number was higher than expected. It was like 20% higher than expected. Unemployment is down on 3.7%. So, all in all, it was a very good report. And still, we haven't seen some big follow through in the dollar yet. So we have to be a little bit more patient. Definitely, the Aussie is suffering here. The Kiwi is also suffering. And Blake mentioned it. I have the exact same zone that he was monitoring here. So, previous support resistance area, we tagged it, 161.8% extension. So this is an interesting level for a pullback. But to be honest, given yesterday's reversal, I think that there are going to be a lot of traders taking advantage of some dollar weakness to be selling dollars. It might not happen today, but it might happen on Monday. I would respect, though, the reversal that we saw at the end of the week, and I would be closely watching it. Now, having to do with metals, one of the most impressive recoveries yesterday was definitely silver. Silver was looking like it was breaking down. Initially, I had this trend line here in mind, and then we had this impressive recovery yesterday that was a huge day higher, which came back to retest this exact same resistance zone. So silver back at resistance. Gold, on the other hand, let's switch to gold and have a look at it. Gold, still within this channel. Still, though, we can't ignore yesterday's candlestick. It almost engulfed 3 bearish days on its own. So, still a potential, especially if silver breaks above that triangle. I think that gold is also going to make another move towards perhaps this confluence of resistances at 1260. That's also the 50% fib of the move lower. But I think we need more evidence here. And given the numbers that we had today with the NFPs, it's likely not going to happen today. I mean, especially if we see something like that happening today, which means that, gold is going to be able to push through, the good numbers and some dollar strength. That's going to be extremely bullish. Likely we're not going to do that today, but we might find some fresh momentum and do that during the upcoming week. All in all, I think that we might see some consolidation in yesterday's ranges in the vast majority of the pairs. So far, the good number doesn't bode very well with stocks, which, if that proves to be the case, first of all, Blake already mentioned that the S&P is testing the 200 DMA. Today, I wrote it in the chat room. I added another quarter in my short position, so I now have a position short. My cost average is at 27.46, something like that. We might get rejected from there. That might bode well with the interpretation that good number means that the chances that the Fed is going to stall and not hike on December definitely get decreased because the market had started pricing in less of a probability of the Fed hiking. But if we're seeing a recovery in the markets, and so far we've had some statements from Fed governors not seem that worried about the sell-off, talking about volatility being normal, etc. So if US data also start coming up good, the market is going to start pricing in again that December is more or less a given, which the markets won't like because we've already seen the first effects of higher rates. I mean, I was showing since several days ago how much home builders have been suffering, how much car industries have been suffering, and how much in general sectors of the economy that usually are looking forward to a recession have been suffering, right? So those are big warning signals, but the rest of the market does not seem to be paying attention. The thing is that those are the sectors that are extremely sensitive to rates. So with rates going higher, and not only that, Coach, if you're here with us, I remember you mentioning several times in the past as well, having to do with the banking sector and how much the banking sector is suffering, right?
Yeah, I remember that actually.
Yeah, which is theoretically speaking, theoretically speaking, because I'm going to give you my interpretation, theoretically speaking is counterintuitive because they had been, they had been, I'm not going to use the expression I wanted, busting our, they had been like giving us a headache by telling us how much higher rates are good for banks. Why? Because banks make money by, in essence, lending long-term, right, and having to pay interest short-term. The problem that people that mention that don't take into account is that, that's the normal banking function, and under normal circumstances and not a bubble kind of circumstances, that would be the case. But what they're not taking into account is that those same banks have in their balance sheets tons and tons of mortgages that once rates start going higher, they're going to start failing, right? I mean, many of the loans they've made to people that have borrowed, taking advantage of like literally zero rates. At some point, the 30-year mortgage rate was something like 3%, 3 point something percent, which is like almost zero for a 30-year period. And they were also taking advantage of the appreciation of the housing prices. So if this whole thing reverses and goes belly up, which means that we've already started seeing the signs, as I said, home builders are going down, stockpile of unsold houses is increasing in a very fast rate. So if rates keep going higher as well, there is a very good chance that the banks are going to start losing a lot more money than they make with regular lending, just because a lot of the loans they've already issued are going to start failing. So
Steve,
I think
that's a very good point. I personally think it depends on the relationship between the two, because the banks, when the curve flattens, it's terrible for the banks. When it steepens, it's good. But like you said, when long-term rates go up, the possibility of mortgages or loans failing is higher. But I think that net
under normal circumstances, under normal circumstances, if this wasn't an economy based on easy money and a lot of people were not very deep in debt, the normal bank function would make more profits for the banks than the failures under a recession. But under current circumstances, I think it's going to be the complete opposite thing. You know what I mean? The complete opposite thing.
It could be. I still think that banks stand to gain more by the yield curve steepening. But you're right. It's a very different circumstances than it was before 2008.
I'm not gonna tell you that my opinion has more credibility than yours, because it's an open debate. But I will tell you one thing for sure: the markets seem to be pricing in something bad for the banks. So it is very likely that they are aware that something like that might be already ongoing, because the banks have a much better idea of their portfolios. You know what I mean, Stelio? So let's see how that's going to play out. We know how it played out in 2008. Almost all of them had to be bailed out, right?
Yeah.
So so let's see how it's going to play out this time. Okay, so let's see what kind of questions we have, and we can take it from there.
Apparently in the Batman series, it was the narrator who said that, saying bad times.
Oh, yeah. I just read that. Okay, cool. So let's see what we haven't already looked at, because Blake has already looked at quite a lot of stuff. Okay, we said the S&P is at the 200 EMA. Let's have a look at the DAX. DAX already penetrated through the first level of resistance. So once again, that opens the 11,800 level for a retest. Keep in mind, that's a actually it's 11,800 to 11,850. This little zone here, this is a very strong area of resistance. So I would be very careful. The closer we get to that, I think that the risk reward points to the possibility of a failure. Same deal with the FTSE. I think the next level of interest is 7,250. So we have some upside left to that. Now, the Nikkei has penetrated through the 22,000 level again, which complicates things again. We might need to pay attention to this trend line. It might act as resistance, and keep in mind that the Nikkei also almost made it to the 200 DMA today again. So keep an eye at these levels, anywhere between 22,300, 22,500. I think we might get a failure from there. The move lower was quite a strong one. So I would guess that there is a decent chance of seeing some more follow through. Now, yesterday, I pointed out to this chart exactly, which was the emerging market index fund, which was pointing to the possibility of a big breakout to the upside. And as you see, we've had like a huge day out of this wedge. Now would be monitoring at this 41 level as resistance, and then at this channel. But in all honesty, as I said, I would expect that there is a big chance of the emerging markets overperforming in US indices in the time to come. So I would be very, very closely paying attention to this channel. If we break above, I think that, even if you don't want to be bearish stocks, it might be worth, playing the spread between emerging markets and the already fatigued trend in the US stocks, right? So you might want to be, for example, long emerging markets and short the S&P. So in essence, this way you're not in general short risk, but you're just betting of some overperformance of emerging markets over the US, which I think is not a bad bet. Shanghai Composite rebounding as well, not in such an impulsive manner. And the FXI, I've been monitoring this pattern in the FXI. As you see, this is an expanding triangle. This trend line support has played out many times so far. Nice rebound again. I think that if we make it above this resistance area, that's going to be pointing higher as well. So this is another index that I'm closely monitoring, having to do with the whole idea. I was just bouncing around with other stocks overperforming the US market. Now, let's have a look at some battered crosses, which is the Euro Aussie, the Pound Aussie. So Euro Aussie today tested the 78.6 and also some horizontal support area. You can see it here. The move lower has been quite strong. We sliced through yesterday. That was a horrible day for the Euro Aussie. We sliced through the confluence of the 61.8 and this horizontal support resistance area like it was nothing. But today, we seem to have found some type of a low. This price action is quite bullish in the short term. So some kind of a rebound might play out from here before seeing, some lower movement again. And, you can see that the same thing happened with the Euro Kiwi. Euro Kiwi seem to be breaking today below this confluence of support, 61.8 and horizontal support resistance area, but we've already created a hammer. So I think we might see, a rebound here as well. Even if it is for us to move lower, I think we should first rebound and work out the oversold conditions in the short term. Let's have a look at the EuroCAD. The EuroCAD, as you see, has more or less stayed in a range. So definitely Euro has performed better against the Canadian in comparison to what the Aussie and the Kiwi have done. And obviously, the chart isn't that clean. Definitely above 147, as long as we remain above 147.40, there is a chance for a rebound here as well. Now, having to do with the pound crosses, obviously having to do with the price action, you understand that we've had an attempt of a reversal here. As you see, we've held the 200 EMA and this horizontal support area in the pound Aussie. So a possibility of a rebound higher from here. Pound Kiwi, we've also held this horizontal support area at 194.50. The moves lower have been stronger than initially expected. So that tells me that there is a good chance there is more downside coming. But I think this is not the place to be selling because, as you see, all of them are currently testing or rebounding from support. So I think we should be looking for shorting opportunities at higher levels during the next few days. Now, let's have a look at the euro and the pound yen. So euro yen, I was monitoring at this descending channel. We had a false break lower at this channel, and now we seem to be breaking above it. So especially if we confirm this break, I think that more choppy price action is to follow because we might rebound towards 130, 150 once again. As you see, the general price action since we broke down from this ascending wedge after the initial move has been very, very choppy. I would still favor some resumption to the downside, but I think that the market is not ready to do that yet. So I would stay away from it. But the next move, if we close above 128.80, I think is going to be to the upside. But as I said, not a clean opportunity here. So in general, I would advise against being short in the short term. I think we will have opportunities to be short again in the longer term. This is what we drew yesterday in the pound yen. Pound yen has rebounded to the next area of resistance after falsely breaking lower here and finding support in the 61.8. Now let's see if it's going to get rejected from there. Generally speaking, as long as we remain below this longer term formation, I think that the chances of a resumption lower are high, but we have already spent a lot of time consolidating, as you see. So once again, I think this is not a slam dunk opportunity. I mean, we still haven't seen the characteristics that we want to have a confirmation that the market has been breaking lower. When we thought we were seeing something like that here, the market reversed. So quite a tough pair to trade during the past few weeks. So I would advise against trying to, if you want to do something in the short term, obviously shorting it against this area and the 200 DMA looks like a good idea. But as I said, just as a short term idea, I think we need to see more to gain more clarity or to gain more confidence that the move lower has resumed. Oil's getting interested as well. Steve, yeah, thank you for reminding me. Actually, we were talking about oil yesterday. Today is going to be a very interesting day for oil. I was mentioning that yesterday, that this is a very nice confluence of supports at oil. I mean, this area between 63.60 and 64.40. And yesterday we closed right at the bottom of that area. Today, so far, we're on the weak side, but it's early in the day. Now, if we close below 63.5, I think that's going to be a very bad signal, and unless like we reverse immediately, like on Monday, and end up like posting a false breakdown just for a single day or something like that, I think that oil is targeting next the 61 area. Why that? Because that's the 127% extension of the last bullish leg higher. So I think that if we lose this area, we should be looking towards 61. So that's another at least $2.50 lower. After 61, the next area of interest is roughly at 58.70. So crude remains under intense pressure. I'm really looking forward to seeing how it closes the week. I think it's going to tell us quite a lot. Might be worth taking a look at the banks index. It's Europe SX7E is telling us something about the state of EU banks. Yes, same applies to the EU. I know that Stelios had an amazing trade. Actually, they actually bought Deutsche Bank right at the lows, and they made like within a few days. Deutsche Bank, for example, has had a nice rebound, something like 10% already, right, Stelio?
Just a bit less, yeah. The timing was very lucky, actually. But
here is Deutsche Bank, 10% from the lows. Deutsche Bank. This is denominated, by the way. This is denominated in dollars, but Deutsche Bank in euros hit what, 8.5, Stelio? Was it 8.5?
Yes. Well, we got the 8.5. It hit a little bit lower, but yeah.
So. Okay. So just look at Deutsche Bank. Just keep in mind that this is the biggest bank of the strongest economy in the Eurozone. Just look at this. This chart is horrible. Just look at this. At the mid 2007, Deutsche Bank was trading at $140, right? Because this is in dollars. Just look at this. And now we're trading at single digits. Just keep that in mind. I mean, it's amazing. Imagine, and theoretically speaking, we're at the end of this expansionary cycle. Imagine what's going to happen during the next recession, right? I mean, this chart is horrific. It's like it's out of a horror movie or something. I mean, yeah, we do get, on occasion some bounces. I mean, but it has now become like a penny stock. You can see like a 10, 15, 20% move higher, which, amazingly, even when you see moves like that, the chart doesn't look any better either way. So, for example, even if we move down from like $9.50 to almost $11, we're just hitting resistance. So from a percentage standpoint, that's going to end up being like a 13% move, which under normal circumstances you would say, whoa, you know, a big bank moving higher 13%. Whoa, that's huge. That's, you know, great. But in that case, I bet that people would be jumping short immediately, right? So that tells you all you need to do to know about banks. If Deutsche Bank is at this horrible state and the chart looks like this, just imagine, and imagine what's going to happen if once again Italian banks, etc., start imploding.
Looks like an island bottom to me, buddy.
You know something, coach? Last time we were looking at Deutsche Bank, I was saying that this is likely a bearish triangle, and I had marked this blue line, and I said you have to respect the downtrend, and most likely this is a triangle that's going to move lower, and I had drawn this line, and I had said back then, the only bullish scenario that can play out is if the bulls actually manage to hold this triangle, push higher towards 21, and break above 21, because then we're going to be looking at an inverted head and shoulders formation. And this is another occasion after this one, because you can see the same deal we had here, and needless to say, here as well, needless to say, because I personally have very good trader friends of mine that have been trying to bottom pick Deutsche Bank for years. And when I say years, I mean years. I have one of my best friends. He's working in a market maker in Netherlands, in Amsterdam. He's an amazing trader. There's no question about it. That's why he gets paid what he gets paid. And he started buying Deutsche Bank when it was like, I don't even remember, like at
Yeah, I'm not saying it was right to buy Deutsche Bank.
Yeah.
Then I'm just saying right now that there probably are a lot of shorts.
I agree with you, but I'm telling you, I know great traders that have always been thinking like, okay, you know, it has to be this. This has to be the bottom. I mean, we're talking about the biggest, bank of the biggest, country in Europe, and Deutsche Bank will never be let to fail. You know what I mean? They're going to do whatever it takes.
I'm just thinking $13.
Yeah, it can happen.
That wouldn't change the picture at all.
No, it wouldn't. It wouldn't. That's the fun part. I mean, the price can literally almost double from the low, and it would still look horrible on the chart, right? And that tells you all you need to know about it.
Are they hiring?
Actually, I know as a fact, because my best man and one of my first friends, I mean, I'm not going to say name, Stelios knows him very well because they're friends as well. We've been friends since 1986, just to give you an idea. One of my first friends in school. He used to work for many years for Deutsche Bank, and I can tell you as a fact that they have been laying off people every single year. They've been reducing every single year people on the payroll. They've been making efforts to restructure again and again. They've been changing CEOs, and as you see, nothing has reversed course so far. And we have a good comment about Stelio. Do you remember the ticker for Commerzbank, which is the second biggest lender in?
Hold on.
Yeah, CBK. There it is.
CBK, yes.
Yeah, and here's Commerzbank. Performing much better, of course, but still, if we zoom out, just look at this chart. I mean, all this price action that we had since 2012, if you just look at the chart here, it just looks like noise, right? Yeah. Obviously, it looks better in the short term, although I have to tell you that if we break below these lows, bye-bye. This looks to me like also like a head and shoulders in the making, right? So I don't know, things don't look that good. Since we're talking about,
let's hear a growl. Let's hear a bear growl out of you.
Yeah, since we're talking about stocks, let me remind you that Apple was one of the few stocks that was actually holding out very well and I just need to bring your attention once again. I showed that in the chat room a long time ago. You don't, if you really believe that the market can recover from here, you don't want to see Apple fulfill this head and shoulders formation, really. Okay. So speaking about Apple, I know it had earnings yesterday. Let's see how it performs today. But you really don't want to see Apple break this head and shoulders formation because it's one of the last.
I think it's going to open up underneath that.
Actually, if I'm not mistaken, Coach, every single other stock
every bank
of the funds besides Apple had entered bear market territory. Every single one besides Apple. So if Apple also breaks this head and shoulders formation, and you know something, in my opinion, in general, and I remind everybody that we will have on Monday, we will have a midterm election special, of course. We're not only going to be talking about politics, but tying that up with how we think that the markets are going to perform. But needless to say, I believe, of course, that they're going to do their best to keep the market afloat until Tuesday. But personally, I couldn't care less about what happens in the midterm elections. Personally, I believe that even if theoretically speaking, the most bullish scenario happens, and let's say that the Republicans manage to retain, Congress, both, House of Representatives and the Senate, I still believe that the market is going to sell off once again afterwards. So personally, I feel quite comfortable positioning myself for another move lower in risk. So that's my general thesis in just a couple of sentences. So, Coach, you have an interview today, right? And I don't want to bleed into it.
Yeah, look at the schedule.
Okay, let's have a look at it. So we have our webinars, we have our scheduled interview, and you have Peter Ghosting. Yeah, we have. I remember Peter. Yeah,
and we've had him before. Peter really isn't. I think that's a lab. He's really a human being, but maybe that's his dog. But 61 point, and he's in the house.
Perfect.
And great analysis, Steve. Have a great weekend. Thank you, Stelios, for coverage of NFP.
For our special webinar about
big panel. Louis Rukeyser will be moderating.
No, really big panel. Everybody's going to be here. Joy is going to be here talking about politics. Blake is going to be here. Stelios.
Ray Dalio.
Peter Schiff. Yeah. Okay.
All those other big shots. Oh, we're going to have all the big shots here. All right, Peter. Here we go. Peter brought a lot of work, a lot of visuals today, so we'll get right into it. How are you, Peter? Hoping everything is smooth with technical things today. Let me see if
Absolutely.
All right, there you are. Your mic is good. You can hear me well,
right?
Your mic is good.
We can hear you. We just can't see your screen yet.
There we go. Okay.
Yeah.
Welcome back.
Thank you so much, Dale. How are you doing?
I'm doing okay, buddy. Interesting times. You tweeted me that you have a lot of charts that you put together to kind of give us your view on the structure of what's going on here. So,
sure.
If we could do this towards the end of it so people know how to find you. Why don't we just dive right into the markets? But everyone knows. Okay, Peter Ghosting, I've interviewed a few times. Peter's an excellent tactician, trader, analyst. We've made a few bets about the market, and he was right about a lot of things, especially the huge rally that we had in the market up until recently. So take it away, buddy.
Can you see my screen? The chart
that I have S&P's up here. Yeah.
So starting at the 2009 low, we had wave 1 into 2011, followed by the summer 2011 crash, which is merely wave 2. And from there on, we embarked on a multi-year rally. We had a little bit of a pause in 2015, 2016. And then we resumed the uptrend, and we had a rally just as
at B is
equal
where
in
you
magnitude as the one from 2011 to 2015.
At B in 2016 was when you said you were backing up the Pinto and loading it up.
Exactly. So that is
bullish. Okay.
And I use, of course, Copsy's approach to Elliott wave here, the harmonic Elliott wave model, where 1, 3, and 5 divides into or subdivide into ABCs, unlike the classic model.
Okay.
So right now, what we've done is we've reached the top of wave 3 or wave C of 3, and we're now in the process of tracing out wave 4 down to, I believe, it could be as low as 2264 to 2280. So something is going to happen, something unexpected that's going to scare the markets out of risk taking, and we'll see what that is.
You have any idea on time, Peter? Like we're 4? When do you think
2019 is going to be very rocky. 2019, nothing's going to happen during that year except choppiness and volatility.
Okay, so from where you have 4, is that in 2019 when 4 is complete?
Yes, but you have to give wave 4 the chance to, or the market to find its rhythm and base itself. It's not going to be a V recovery. Okay, it might be a triangle, it might be some sort of consolidation pattern. And you know, just like in 2015, 2016, you had the first installment in summer 2015. We came back down and retested in February 2016, which was that zigzag here. B formed a zigzag. We came down, we hit that trend line, completed wave B of 3. While other indices, by the way, held their August 2015 lows. So nominally speaking, other indices did complete their corrections around August 2015, came down and retested in February 2016. So the same kind of story is going to happen. It's going to take some time. And then after that, you'll have wave 5, which I believe once things clear out, whatever those things are, we'll look back in retrospect and we'll see that this and that happened, and that's what the market was anticipating, and that's why people were taking off risk, or the big money was. Okay. So 5 will actually take us up from about 2,300 to 3,600. So we're going to have another phenomenal run, after which something is going to happen again to bring us back down to that area. Okay, but I'm not gonna.
Yeah, that's way out there.
That's way out there. Too much prognostication.
So yeah, the important things to get right is if we have a failing rally here, and then ride it, let the market wash out, and then have your shopping list ready of things that you think are going to lead. I actually think commodity stocks may lead in this next rally. What do you think?
I don't look at them much at all. I have not looked at commodities in years.
Yeah, okay.
All right, I'm focused mainly on stocks, and in particular the semiconductors, which I believe are one of the engines of the new tech-driven modern economy. Now, if you look at the NASDAQ, same kind of chart, same exact formation. Blue 1, 2, we finished blue 3, and now we're in the process of tracing out wave 4. Okay, and that bearish crab target was my target since 2013. So we've had an incredible run, and I was pretty surprised when we exceeded it. But then when I looked at the pattern in mid 2018, I couldn't find a wave 4 or wave 5, red wave 5. So that's why I predicted that that's going to be another brief rally to set things up for the ultimate correction.
Okay.
Same thing with the Dow, same exact pattern. You'll notice when I bring up the Dow, exact same pattern. And The Russell, same exact thing. The subdivisions are unmistakable. Most importantly for me is the SOX. The SOX, if you know, or as you know, actually topped in March, okay? Yeah. And then after that, while the other indices were forging ahead, the SOX failed to make a new high. So that was one of the first ominous signals that, hey, if the semiconductors that were outperforming and leading the market are not, are lagging now, that was the same exact situation we had back in 2011 around February and March.
Yeah, I noticed that.
Right. So, and the other thing that I look at, other than the SOX itself, before I move along, notice the massive rounding bottom right here.
Yeah.
And this correction really is nothing but the handle that goes with the massive rounding bottom.
Okay, so you're looking for the handle to form on the cup.
Exactly. And you know what? This brings back memories of this. You had a rounding bottom in the NASDAQ composite, and the correction in 2015, 2016 was the handle. Okay, that's exactly what's going on right here, for me at least.
Only now, bigger handle, bigger move.
Bigger move, exactly.
And this handle comes back to check that breakout.
Exactly. Now
it all comes together, Peter.
For the
I feel like I know the jigsaw puzzle now.
That's how. Let me tell you, it's like the hand of God is moving the pieces on the board.
Yeah.
You know?
Yeah.
So if you look, here are the some of the signals that I've been monitoring almost on a daily basis. I monitor in particular a ratio that has served me really well. I came up with that in 2013, and that's the ratio of the semiconductors to the S&P 500. If you look at it here in 2011, when the ratio reached the 2007 high, we embarked on that correction, and the index kept falling. In other words, the SOX kept underperforming the S&P into early 2013. It based itself, formed a bottom, head and shoulders bottom, and then rallied again to that same exact level. And that happened in 2015, 2016. The ratio came back down to, you know, a support area, came back up in 2016 or so, finally broke through. And that's when I predicted that a major rally is going to develop, led by the semiconductors, which were finally outperforming and trying to catch up to the other indices. Now look what happened here in 2018. We registered the high in this ratio early 2018, came back down, bounced off support, came back up to see if we can exceed that high. We couldn't, and we left. And what we were left with is a topping formation. So as the semiconductors were basically the guiding light here, or the forward-looking indicator as to what to expect. Risk was coming out of the market in a stealthy way. And then the other thing that I look at is the breadth. I look at participation. And if you look at what happened in 2015, 2016, the market was, you know, registering one high after another, at least the popular indices were. But look at the number of stocks making a new yearly high. They were pathetically low. So if you don't have participation, how can you sustain these high levels? That's when we crashed in summer 2015, came back down and tested in 2016.
Right.
The same exact thing happened right here. You know, look, we had that blow-off rally in January 2018, which blew my mind, the way the market moved in January compared to the decline in December. And ever since then, look at how participation kept dwindling down all the way to a point where the string finally snapped. The other measure.
Let me ask you a question, Peter. So, you know, the averages have kind of masked all that weakness that you're showing in that last chart. Okay. So is it possible that when we're near a bottom, that the shares, the internals, will get better when the averages are looking sicker to keep people away from the market?
Right. And if you think back at 2016, the S&P made a new low, the NASDAQ made a new low, but other less observed
like the NYSE.
Even the semiconductors, the banking index, those guys came back down and didn't breach their August low. So they formed a divergence. Actually, you could also see the divergence in breadth, in various measures of breadth. Here, I like to look at participation by looking at the equal weighted versus the weighted S&P 500. If the high capitalization stocks are what are thrusting the weighted index up, you have to also take into consideration the equal weighted to see if the tide is lifting all boats. Is there enough participation from the other stocks other than the FANGs and all those guys and everybody? So here, in August 2012, by the way, remember when we bottomed in 2008, now we started having good participation all the way up to 2011. And then we came down, that was, into 2013 or 2012. That's when the index or the ratio bottomed. From 2012 to 2015, we had excellent participation. That's why we had what do we call that rally? BTFD, if you know what I mean.
Yeah.
And then we came back.
What's interesting is the November 08 low was so far above the 2000 low, it almost looks like, and that was a financial crisis.
Right.
Really, it didn't do that much damage to equal weight.
No, you're right. You're right. You're absolutely right. But then you might be comparing two different things here because they're so far apart. The stocks that were in the indices.
They're always changing.
You're right. So
they got rid of the dogs and put in the ponies.
Right. Exactly.
I got it. Okay, good point.
So here's what's interesting here. You have that look of a head and shoulders because the market made a new high in 2016, 17. This is the entire 2016. Notice that the ratio didn't even, it came very close to its previous high here, but the indices were making new highs. Eventually, we had that topping formation. We broke below the neckline, and we're actually, this ratio right here is trading below its 2015, 2016 low right now.
So that's kind of bearish.
Yeah, it's bearish.
It's still bearish.
Exactly. Okay. Now, the other thing of interest that I keep track of is, the bonds. I look at the bonds, and here's the picture, because bonds will tell you a lot about what to expect in the market. So February 2016, we bottomed. Or you can go back to June 2014 when they topped, and then they gradually began to fall. Partial rally into March, May 2015. The indices were making a new high, and then they took a dump right here. They turned back down, and the market followed through. And then when we bottomed 2016, the market rallied as well.
Right.
They topped in 2017. This is 2018, the scare of, the scare that we had earlier in the year. Partial bounce. During that partial bounce, the market made a new high, or most indices did, just like they did in May 2015 or March 2015. And now we're about to break below the neckline at some point. Okay.
So this is bearish bonds, at least near term.
Right. So if you look at the purple line here, the dotted line or the dashed line, I show a corrective ABC pattern. So eventually, for me to time the end of the correction, I want to see the bonds reached this level, or at least this particular ETF reached the 4370 level, below which everything was rejected earlier back in 2016. So you have that red line here.
You know, a lot of people don't follow this as much as maybe the 10-year yield. Would that take take the 10-year yield maybe back to
same pattern, by the way,
250, something like that?
Right. So you'll see on whatever ETF you look at, 10-year, 5-year, whatever, they all sport the same pattern. I just happen to be using
this would take the 10-year yield higher, above the 3.25, right? So it could go to 4%.
Right.
If you're looking at that. Okay. Got it.
Last but not least, or actually a couple of more things I'll show you, is the banking index, which is very important. The banking index is a broad-based index, capitalization weighted.
Yeah.
Same exact pattern as I discussed earlier, wave 2, A, B, C into 3. 3 ended inside the crab PRZ. So eventually we're going to get to that level, 48.67, but not now. And notice how close we came in October to my target. You have a lot of support here near 33.30 to 32.36. So right now we're in bounce mode, okay? Right now the market is in bounce mode. I don't know if you saw my chart from yesterday, but what I expect in the S&P is a bounce which will be more or less touted as a Santa Claus rally, end of year rally, whatever. But look what's going to happen here. So we started a bounce. Right now, as we speak, we're around the 20-day moving average. But if you rely on the 50-day moving average as your trend indicator, we are trading well below it.
Yeah.
And
it'll come in up there around 2,800. I think it's 2820 now, or 40 or something like that.
2811 would be the S&P at that level, 2811. So I'm looking for 2811, 2812 for the right shoulder to form. And I'd like to give some historical perspective. The rally in May, June of 2011 did the same exact thing. Everything was celebrating it, but it was merely a right shoulder of a head and shoulders pattern back then.
So this rally could be 2 months and take us into December?
Right, it could take us into December. I think we have the low of the year, or the low of this current correction, already in place. Right now, what we're going to do is we're gonna chop around while we're trudging higher towards the top 4.
Take the VIX back down to 14, but it'll be still higher than the last level of 10-12, something like that. Yeah, so build complacency into Christmas, and then pull the rug out going into, then the Fed pulls the rug out in December again.
You got that right. So that's exactly
we got it all cased. Do you have your lawn chair set up on that tropical island that you and I are going to have a margarita in January?
We should do that, right? We should definitely do that. We should definitely do that.
All right. Well, God, you know, I'm so glad you wanted to come back, Peter, after the technical glitches. And the best way for people to find you is, here's your website. Nice site. Let me just see. I think one of my alerts are going off. Okay.
I'm at Peter Goldstein on Twitter, 61.8 on the web. And by the way, I'm sorry about the technical snafu we had this time. It was really unnerving.
It was, you know what? It was meant to be now to prepare everyone for what's coming up, because a lot of people are going to get complacent. One of the guys I have respect for in Elliott work actually, I think, changed his mind looking for 3,200 in the S&P, but I don't know. He's not always right. I could see this being a failing rally too, and one more washout, because we never really reached the capitulation type stage on its decline. But I'll tell you what, I was in bearish ETFs at the top, and I want to tip my hat to anyone who was able to ride it for a month, because it was not easy to sit with a position with the way it traded down to here. Now, I think that this failing rally, if it pans out to be that way, will not be up 500, down 500.
No,
it'll be directional. And, you know,
if I'm right, the next leg down will be a wealth maker. So you just have to sit it out, and not sit out the decline, but wait out this rally. And the way I'm trading it right now, is I sold premium below SPY 250, 245 put premium, or put spread. I sell that credit put spread, and I sold 285, 290 call spread. So I'm an iron condor, 245, 250, 285, 290. And you know what? That's into December. So I'm doing nothing during the day except looking at the charts and going about my life.
And collecting premium in the collar.
For the viewers, another way to time the bottom is via the SOX, the measured move of this triangle, which, by the way, is a Wyckoff top for Wyckoff practitioners. This is a typical Wyckoff top. The measured move is the low of wave 4 from back in, when was that?
Wave 4 of lesser degree.
I forgot. Yeah, this was 2018, earlier 2018, this low right here. So we ended up doing wave 5. No, actually, that was 2017, I believe. July, September 2017 is where wave 4 came. So can we go a little lower? Yes, but right now my timing will revolve around the 1028 to 1010 or something, in that area right here, more or less, because I'll be selling premium below this purple area.
And well, you like playing the house in options, and you know that's the way to go. As long as you know how to get out of the way if one of your strikes is taken out. You know,
exactly.
You know, it's like picking up nickels on the sidewalk till the steamroller comes. You know, I've seen that steamroller. So,
and look, there'll be times when once you time the market in terms of you know, a significant move up or down, you can go directional with options. It's not always about selling premium, but the market trends up or down 5% of the time. So most people that buy puts and calls end up on the short end of the stick.
That's because of the decay. You have to get
vicious, man. Vicious. So.
Well, you know, when in my cynical days, I used to say options are like relationships. 90% of them expire worthless. But I'll tell you what, I'm glad I maintained my relationship with you, Peter, in that 10%, because what a great presentation. And I know I could relax until December and get my, you know, grub stake together and take advantage of this decline. So
that's right. And by the way, Dale, you're doing a really great service. I keep my eye on what you're doing. It's pretty phenomenal. So hats off to what you're doing, my friend.
Well, thank you, my trading warrior brother. They'll think we have a bromance going here, and I love you.
Love you too.
So, all right. So have a great weekend, Peter. I hope pips rain down on you. Till we meet again, and keep in touch.
Thank you so much. Have a great weekend.
Okay, everyone, get Peter's letter and follow him on Twitter at Peter Goldstein. And face people, have a great weekend. You're welcome, Tom. You're welcome, Nick. And I'm looking forward to working with everyone again next week. Enjoy your weekend, but remember, don't just count your pips, count your blessings. Adios, warriors. See you Monday. Thanks again, Peter.
Thank you.